Monaco 64, home of alternative economics and contrarian views. So this is an afternoon special. I usually don't do a video in the afternoon, but I thought it was important that we touch upon what's going on in copper. It's a very technical situation. I didn't catch on to it. It happened yesterday, but Rafi warned me about it. He sent me an email earlier today. And thank you, Rafi, for that. And welcome.
Welcome, Mario. It's good to be back.
Yeah. And we've spoken about backwardation before, and you are, I would say, one of the experts in backwardation. And before we go on to what you think is going on in copper and what it could translate to in terms of other commodities, especially the monetary commodities, just wanted to go through an article here that came out just a few hours ago about copper in the FT, and then we'll go on to what Rafi thinks. So just to let you guys know, it says London Metal Exchange moves to stem draining copper reserves. I would say when we read through this, I would have put the title of this article as almost like they declared force majeure, or it's almost like a default, but let's keep going. Inventories of the metal have fallen this month to their lowest levels in 47 years. It's interesting, if we go back 47 years, what was happening then? Well, we had the Bretton Woods had just collapsed. We had a massive bull market in commodities, and we had a lot of inflation. But anyway, it says the London Metal Exchange took action to calm turmoil in the copper market late on Tuesday by introducing temporary limits on some prices, pretty much like Nixon temporary, I guess.
Yeah, Nixon took action. Nixon took action to calm turmoil in the gold market by introducing a temporary limit on the gold exchange price.
Yeah, that's right. After a plunge in stocks of the metal in its warehouses disrupted trading, the LME said it would adjust its rules, requiring large holders of the metal to lend it back to the exchange. Well, what if they needed to deliver to clients? Why would they want to lend, right? Anyway, it also said it would bring in a limit on backwardation. That sounds a bit strange. How can you limit backwardation? Is like limiting the price of something. But a scenario whereby spot contracts trade at a premium to futures contracts, indicating that the market is undersupplied. Bear with us. Rafi is going to explain to us exactly what backwardation means in a minute. Robust demand on rising copper prices pushed inventories of copper on the LME to their lowest levels since 1974 this month. Stocks stand at 15,225 tons, compared with more than 200,000 tons as recently as September. This is quite amazing. It's not September 2020, it's September 2021. So this is very, that's a really sharp drop, isn't it? I mean, it's amazing. That in turn has pushed spot prices to record high versus future prices, more than $1,000 a ton this week. And one thing about the LME data, because I've looked at the LME website, you have to pay for live data. So to see what went on today, we're going to have to wait until tomorrow. We might get some people tweeting about it. Like there's a guy from Bloomberg that tweeted about it last night. So we're going to keep an eye on this. So just continue here. We see this as a shot across the bow of trading firms in copper, and is likely to mean that the extreme cash price level seen yesterday is unlikely to be repeated. Colin Hamilton, an analyst at BMO Capital Markets, while he works for a bank, he's saying
he's saying it's transitory, huh?
Sorry, go ahead. Can you?
Colin Hamilton is saying this copper spike is transitory, I guess.
Yeah, and I guess he's a banker. He doesn't see that it might be a shot across the bow of the central banks that their currencies might not be as acceptable as copper. Copper prices have risen 12% over the past month and are trading close to their 10-year high of 10,748 a ton reached in May. And I will specify that the copper that we usually look at in the morning, high-grade copper, that's traded on the CME. The LME is the biggest base metal or industrial metal exchange in the world. Anyway, as demand remains strong in China, the world's largest consumer, unlike most futures exchanges, the LME's contracts are based on physical metal that sits in its network of warehouses, which stretch from Rotterdam to Malaysia. Interesting, Rafi, that they say it's based on physical metal and they're still having problems with supply. Can you imagine for COMEX, an exchange that's based on paper, if you have a sniff of backwardation and demand for physical, you can understand why things could get really interesting. And it says, but large requests to withdraw metal over the past month have left extremely low levels of copper stocks on the exchange, which threatens the LME's connection to the physical market. This week, backwardation on the copper contract reached $1,104 per ton, a record high. So that dollar amount is how much more the spot price costs than the 3-month price.
Yeah,
that's backwardation. Commodity trader Trafigura has been behind the request to withdraw the metal, Bloomberg reported. So anyway, Rafi, what have you got to say then about this copper situation?
Am
and
I able to share
backwardation?
screen also?
I think you can. Let's have a look.
I think you have to enable it.
Multiple. Okay. Yeah. Now you can.
Sure. Here. Okay. Do you see it?
Yeah.
Okay. Oh, what was your copper bar?
Just wanted to show you. Yeah. It was my kilo bar. It's not worth. At least I got physical.
Yeah. So here's a chart of what just happened, and this is if you see here on this Bloom. I'll try to zoom in here a little bit. Can I do that? Whatever. Okay. So if
I think it's pretty clear. Yeah. Okay.
You see this chart? There's two lines. There's the black line, and that says the LME on warrant copper stockpiles. So that's the right axis where it says tons.
That's dropped a lot, hasn't it, from above to?
And then you see the red line, or is it the green line? I don't know. I'm colorblind, but it's not the black.
It's red.
Line. Red. Okay. So it's the red line, and the left axis is dollars a ton. So as you see that copper stocks have collapsed from September to now to almost zero, very close to zero, and then all of a sudden the price just spikes, just goes vertical. This is copper. But this is exactly what is going to happen to gold and silver once people get wind that the dollar is collapsing and they need to get their hands on real money. You're going to see severe backwardation in both gold and silver, and this is what is going to happen. You're going to have severe backwardation and all of a sudden a vertical price spike, and that's going to signal the collapse of the dollar. Copper is something different. Copper is not exactly money. It's like a quasi money, but you can see we're already getting close to a point where something very dramatic is going to happen. And if we're talking about how this backwardation, I guess you can describe it in many different ways. Just take it mathematically, that if the spot prices for copper now are way more expensive than the prices for copper in 3 months, then for futures traders, that is heavily incentivizing rolling over instead of delivery. Because if you have to pay a huge premium for physical delivery rather than being paid to roll over, because if, let's say you have a spot contract that's, I don't know, whatever, $1,000, and 3 months, it's $500. So you're basically being paid $500 to roll over and get that cheaper copper 3 months from now. It's like $500 in free copper. So it's telling you, do not deliver, do not ask for this delivery, you'll be paying a premium. So then why would traders insist on delivery, even if they have to pay an extreme premium for it. But because like it reminds me of the last scene in Trading Places, in that Dan Aykroyd, Eddie Murphy movie, right? They're trying to corner the frozen concentrated orange juice market, and they just keep buying. That's what's happening here, because they think that if they can corner the copper market, they can have the entire supply and then just, sell it for whatever they want. They can monopolize, they can corner it. And what I in this article, did something, let me search for the word here. Delivery, where there was a part where it said they were suspending delivery rules and making it optional for short contract holders not to deliver temporarily. So that basically is a default or a force majeure, and they're legalizing it. But that, if you think this isn't going to happen in gold and silver, it's going to happen. It's going to happen everywhere, and there's going to be defaults everywhere. And then all that's going to matter is who has the actual physical stuff. The paper contracts are all going to be worthless. I'm not just gold and silver, but everything. All these exchanges are going to collapse, and then we're going to have to go back to a gold standard where the futures themselves are priced in gold and silver, and that is what will balance the market and make things move again.
Yeah, can you explain to viewers why backwardation is not normal in a commodities market?
Well, backwardation is normal in commodities markets at certain times. There's nothing wrong with it. It just means that there isn't enough of a supply to compensate for a spike in demand. Let's say there's like a very, very cold winter spell or something, and you need a lot of heating oil, and there isn't enough of it. So what happens is that there's a huge demand suddenly for heating oil, and then the price for immediate delivery of that goes higher than the futures price, because people want the heating oil now rather than saving because they're freezing. So they pay a premium for delivery, and that's fine as long as whatever is causing that is temporary. So what happens during a backwardation is that firms or companies that stockpile whatever commodity it happens to be, whether it's copper, heating oil, crude oil, gold, silver, whatever, they're incentivized to get rid of those stocks because they want to lock in those premiums. So then the stocks of the extra stuff that's been saved up go lower and lower, and that's okay for temporary purposes, because by flooding the market with supply now, you're pushing the price down so that producers can catch up and make more for the future. The problem is with backwardation, it just keeps persisting, and commodity markets have been locked in backwardation since 2020, sometime in 2020. I don't remember exactly when, maybe around for about a year now. They've been locked in backwardation generally, not every single one, but there's been heavy backwardation in many commodities for a year. And what that does, it does the opposite. It continually incentivizes those that stockpile the commodity to keep destocking and flooding the market with supply. But if the price doesn't go down after that, then they have no more stocks. And if the demand persists, then demand persists when there's no supply, and the price goes even higher. And why is that happening? It's a combination between the collapsing value of the currency and the fact that firms have been so super concentrated and ultra pursuing ultra efficiency, that you have these mega corporations and mega firms that have these very stunted, jolted regulations, that now that the world has changed, they're having these bottleneck problems that they'd have to change their entire structure in order to solve. So it's a combination of a collapsing currency and the way the economy is structured that makes it very hard for bottlenecks to be cleared up in this environment.
Yeah, usually commodities markets are in contango, which means that let's say you pay $2,000 for gold for spot delivery, but in 3 months you're going to pay $2,100, which is the cost of storing. And it's the same thing for copper. If you want copper delivered in 6 or 12 months, it's going to cost more because it usually costs more to store. That's the opposite of backwardation. It's contango. So you said that a lot of other commodities have been in backwardation. I guess it's to do a little bit with all the lockdowns and the supply chain disruption. Someone would argue that it's got nothing to do with the dollar. But what's your counter argument for that way of thinking?
Why it does have to do with the dollar?
Yeah, because the guy from BMO, for example, he's just saying, well, these copper traders must be careful. They're gonna get burnt with this backwardation. But he doesn't seem to understand that backwardation is also the flip side of it's when people don't want dollars anymore and they want physical things.
Mhm. Well, we are seeing on the consumer level that consumers are wanting dollars less and less because they want stuff more and more, which is why consumer prices are heading higher. So meaning he's trying to isolate one area of the economy and say, in this area specifically, it's not that people don't want dollars, it's that they want copper. But then what about all the other commodities that are in backwardation? That they're saying that they want supply now and they don't want to roll over, because if they roll over, they're keeping the dollars, and if they take the supply now, they have the supply. But so you can rationalize any single market. Like, it's more that you have to see the economy and all these exchanges as a homunculus. That concept that it's a philosophical concept that, imagine there is this like giant person and each brain cell is one human, and it makes a giant brain. So that's really what the economy is. It's a homunculus. So any one part of it, you can make an explanation for why it's really this isolated market, but it's not the dollar. But all of it together is a system. And when all of this stuff is in backwardation and consumer prices are rising all over the place, then yeah, taken holistically, it seems that nobody wants dollars, and no individual regular trader is going to admit that, but that is functionally what's happening. And the end process of it is when this subconscious process of when people don't want dollars and they want their contracts, probably they're trying to eke out some kind of weird trading profit as a futures trader in the copper market by doing something technical. But it all adds up to the final psychological realization among consumers that, yeah, we got to get out of this currency now. And it all builds up, and then there's a trigger, and then bam, it's done.
Yeah. So do you think we're going to start seeing backwardation in silver or gold first? Which one do you think we're going to see the first signs of tightness? I personally would say it would probably be silver.
Yeah, I would guess it's silver. I mean, I'm not going to stake any bets on whether I'm right or wrong in this. Right, silver is more of an industrial commodity, so you'll see more of a demand for silver for industry that will start to hoard it more and more, and that would make it more backwardated sooner. And when gold goes into backwardation, that would be just people looking to preserve the value of anything and just buying gold and taking it. So
I just forgot to ask you before we wrap up. How's the delivery situation for your silver going?
It's not good.
Crimex.
Yeah, it's not good. I called the COMEX, and the COMEX told me that they don't talk to individuals. They're not even allowed to answer the phone. I don't know if they're allowed to. They don't talk to individuals over the phone about their warrants. They have to talk to the broker. So I said, okay, who do I talk to? She's like, oh, contact this guy. And she gave me the name of a guy and his phone number at Interactive. And so I called him. He didn't answer the phone. I called customer service, and they said that they would call him and he would get back to me. And then I just got a message from customer service written that says that this guy told us that Interactive never does loadout. Loadout means the actual physical delivery. Never does loadout as a means of delivery, and never has. So my next step, I have an old contact at the COMEX. My cousin used to work for them. Maybe he can get me this guy's number and I can work it out, or I can call the COMEX directly again and annoy them. I'm trying to figure out what to do. This doesn't surprise me at all. But if this doesn't work, I'll have to sell the contract, sell the warrant, and switch brokers and try again. Who knows?
Yeah, I think it just shows that for the small retail investors, they make it as hard as possible to take delivery because it's not a true physical market. And I'm not surprised, but I hope that you do get your five 1,000 ounce bars that you would get.
It's not exactly that. Generally, that's the estimation. My specific warrant is for 5,101 ounces of silver because it's assigned to 5 specific bars, and they're not all exactly 1,000 ounces.
Oh, I see. So would you have to pay a little more because the futures contract is for 5,000 ounces?
Yeah, I'm not even sure about that. I couldn't even get an answer about that. I'm not sure if I paid for this specific warrant and that's why I had to put the extra cash in the first place, or if I actually succeed in loadout, are they going to charge me for those extra 101 ounces? I don't even know. Nobody can answer these questions for me.
Let's see. All right. Great, Rafi. Thank you for your time. And before I go, I like to recommend Rafi's YouTube channel. It's called Rafi Farber. Pretty easy. And he does great videos. I think he's almost got 2,000 subscribers. So it's a good channel and I recommend it.
Thank you. And I recommend your channel also.
Thank you. Take care, Rafi, and I'll talk to you later.
Okay. Have a good day.